All right, guys. This is an Edge group coaching session. Woj has been nice enough to join us. He did an event for us back in, I think, in October, November of last year, and that was more of a Q&A discussion about his background, his prop background being similar to mine. He went to Southern California, opened up a prop firm, talked about why that was tough to do, came back to Chicago, worked and is at a prop firm, but trading more spreads than outrights. And outrights, like we said, we're not here to teach you guys in this particular session the intricacies of spreads, but the price direction of anything, whether it's a spread or an outright. So the word outright is just one singular instrument. Anytime the word outright is used, it's just getting in and out one particular instrument. So the ES would be an outright. And if you take an ES and trade it against the NASDAQ, then that's a S&P NASDAQ spread. But that's as far as I'm going to kind of explain that. Now, what you're seeing is the charts that Woj typically looks at and the markets that he trades, and I'll let you just, Woj, take it from there.
Okay, so what I do every day is I'll go to this screen here, and these are outright prices or outright products, and what you're seeing is from top left clockwise is 5-year, 10-year bonds and S&P. And what this chart is just a point and figure chart, so if many of you use charts, you can find this in probably chart types. Bar chart, here's point and figure. I use that a lot. A lot of guys might, there's some free charts that I think I talked about last time where Thinkorswim, I know they have that. You can sign up for an account and get free charts that way. But they do have this. What this chart does is it shows me price stripped out of time. And for an example of today, just using the 5-year, 10-year or bond example, you can see the high price for resistance and kind of support here. Everything in between these lines, these pink lines, is kind of noise in my opinion. And I look and find out where would be the best price for me to get long and short from. And as the market was racing after Yellen was talking in her Humphrey Hawkins testimony, you can see here it got to this resistance line, and I kind of made a lot of guys aware that if we break through 119.30 and in any relevant treasury market, it could be some buy stop set off. And sure enough, when we got up there, we blew through those stops. And what I'm looking at are the highs of these bars here, showing me a lot of resistance going back, 2 weeks of time. So the market has been in this channel for a long time, and every single product I look at, except for the S&Ps, the S&Ps are a lot tighter. I don't trade S&Ps, so I can't give you a lot of good insight on where technicals are. I guess the best thing to do is just get long every day, because you got a lot of central banks buying it with you. So that's the first thing I kind of wanted to show you guys, is if you can get some point and figure charts, it'll help you strip out a lot of time and a lot of noise, and you can really see where we've been at on the low side of our bands and then on the high side.
Hey, Woj, let me stop you
Yeah.
there, because it wasn't my whole career or yours either, but I bled into P&F charts once I kind of realized it was a better rotational look, and you use a good phrase. So all these guys are used to P&Fs, because that's what
Good. Fantastic.
I like the way you say it strips time out, because it does. It shows you truer rotations than a time period bar.
And that's real important. I mean, look how many days back we're going, and we've been in, a 10, 15 tick range, where I'll slide my chart over, and you can see what, just look at the first box. This is the 5-year. I mean, how do you make any sense of this, of where you want to get involved at? I mean, you don't even see support and resistance unless you make it a much larger scale. And because I have so many markets up, it gets kind of difficult to see where past and future resistance might be.
Yeah, you can't get any reference when you're
Right.
looking too boxed up, and you got to be able to pull it back. No, so when did you start using P&Fs though?
Uh, maybe about 2 years ago, so relatively recent myself as far as, you know,
Yeah, now me too.
something
I was
different
about
here.
4 years ago. When you used to only look at 2 minutes, 5 minutes, 15 minutes,
I
and that
do.
was enough. That was giving us what we needed. But then you had to see truer and deeper rotations, and you found out this is a better, more accurate indication of how the markets are moving. You know, and where they're stopping, the end of a move, top of a move, pullback, and things like that. That had no relevance to a 5 minute period expiring and opening up a new one. I want to know long P&F bars mean pretty good rallies or breaks, you know. So, all right,
Right.
that I don't want to interrupt you. I
No,
thought
that's all right.
P&Fs are cool.
100% right. The one thing that, just goes to show why I trade spreads today versus flat price is looking back on the top two charts, the first two charts. I'm kind of hovering over the 5-year, and I have the 10-year pegged right there at 11:30 on Friday. And the reason what I'm going to tell you is they came in agreement. The Eurogroup and Greece came up with an agreement, and they set terms to a bailout extension. And what happened was the S&P rallied, and the bond market was supposed to sell off. Well, what happened in my bond market is, get rid of this. You can see I sold 128 even right here, and the market went down. I had a winner, and it shot back up. It was 6 ticks against me, and I had a lot on. It was about an $18,000 loser had I not been hedged up. So spreads, in my opinion, aren't anything different than a way to smooth out volatility. And that's basically why I did it, or why I learned how to spread. What I did was I sold the 10-year and I bought the 5-year. Not to get into a lot of detail about the intricacies of spreading, but I was able to weather, quite a bit of heat for the amount of size I had on, and then I rode this market down to about right here. And I turned a $2,000 loser into a $4,000 winner. Had I not been spread off, it would have been, it could have been $10,000 to anywhere $15,000 if I hadn't puked quick enough. So that's just an example of how dicey these markets are these days. When things are trading off of news and volatility, you can be right in the direction initially and take some heat, and watch a loser turn into the winner that you were looking for. Not too much time later. Let's go right here and what was going on. So at 5:30 in the morning on Sunday night or Monday morning, this is after the Euro stocks had opened up and Boone and Bobble are open, and directly under where I'm pointing here, you can see this market right here is the Boone, which is the German 10-year. And what happened? I was bullish treasuries going into this just based off of where the DAX is to the right of my chart here. This is the DAX. So the opposite of that is going to be a bullish move versus this sell-off in the DAX. And you can see the 10-year testing its low.
Hey,
This
wait,
is a double
Woj,
bottom in my opinion. It's what I
Woj,
call it.
real quick,
Yeah,
just so people know,
yeah,
'cause it's important to look, and you're doing a good job. Just his blue, you could see how he's got a correlating line. See where his blue bar is on each? That's showing you the exact reaction in the DAX versus the Boone. So go ahead. It just highlights blue when you're looking at both so you could follow it accurately. There you
yeah.
go. Yeah,
Scale
all
them
right.
over one by one. You can see I was long over here and I was taking a lot of heat. I saw the DAX selling off. Not a lot, nothing major to really get me long. But what was happening was the Boone was really taking out. See the lows of these bars. All the lows are moving higher, and you can see at this point the 10-year really sold off against not a big downtick in the Boone, and the DAX was just coming off high. So I was long already. I was long spreads spread bias, and I held it through the sell-off in the 10-year, and I was going to puke if we rolled over or the market turned over a little bit more in the boom. The market wasn't going, the spread wasn't too far against me, so it was fine to take the heat that I was already in. And as it touched off this low from this period right here, the DAX sold off, the boom turned bid, and the 10-year got off its double bottom. So that in an ancillary market, or markets that I use to help me trade off of one product, I had two markets, the DAX and the Bobble and the Boon, telling me that the treasuries, the 10-year treasury right here, was undervalued and staying long was a good idea. That's an example that I wanted to show you as far as ancillary markets go. Since Sunday night and last week, there hasn't been too many very good indicators. We've been shopping around waiting for Humphrey Hawkins to get rolling this morning. So I haven't really seen too much as far as directional bias out of Humphrey Hawkins for treasuries. I haven't seen a reason for this rally that we're seeing right now. The only thing that I do see in the equity market is for this sell-off, she said asset prices were way overvalued, meaning equities and certain equity type of instruments that are derivative based out of equities are overvalued. And you can see on the bottom right of my corner at 10:30 is when she said that, and that's exactly when we started the sell-off in equities.
She had to wait till she was short and filled.
Yeah, that's the only thing I got, guys. I apologize. It's been really choppy, uneventful. What's going on in the Treasury market these days is we're rolling from March to June, and the bond market has a really big hole in it. They're rolling out 7 years of duration from a 15-year bond to a 21-year bond, and it's really causing a lot of problems in the Treasury market. So I've been kind of avoiding the longer end of the curve, trading more shorter end curve because it seems to be a lot more stable.
Hey, a couple things to add is that what we talk about, what I preach so much is ancillary markets. And in your example, if you weren't paying attention to correlations, you would have let price get you out of the trade. If you just watch price of the market you're in, you have no good reference of what could happen next or a sense of confidence.
I hold losers a lot. I hold it better when markets are against me and something else is telling me that I have a strong chance of being right in this. That markets do fluctuate. No kidding. I mean, everybody knows that. And sometimes they fluctuate, your winner's right into a loser. But if I can hold that loser long enough, and that's why, I'm not trying to preach spreads or anything like that. You guys, there's a lot of ways to skin staying in the game or, taking quick losers and getting back in on a trade. But spreading for me helped me weather that, that downturn in 5 and a 10-year while the Bobble was going up, DAX was selling off. I just had a lot of conviction that I think I'm right in this, and I was willing to take the risk.
And you still know where you're going to get out.
Right.
If it doesn't
Going
go.
back to that example over here, I was going to puke it if it got, if it broke below its lows. I mean, it could have broke its lows and then turned bid. I mean, it's just the way it goes. But I was able to hold it. If I was long through here and then took this heat, I mean, that's 6 ticks. I mean, that's a lot of money to risk. That's 8 ticks right there.
Yeah,
30,
that's
$15 a tick. I mean,
yeah, because the 10 years trade in half ticks. The Boon Bobble kept you in, so not just price, but also if they turn, right? If you got the DAX to really pop or the Boon to turn lower, that would have been your next. But they were
had the DAX continued to trade higher and the Boon and the Bobble rolled over and sold off, it was an immediate, I got to punch out of this thing.
It keeps you watching what's important, but it allows you, what you had said is pretty powerful based. Here's what you said that really resonates with me. Your best trades are the ones you're able to weather a little bit of a storm. And really what the shakeout is, you're able to weather the shakeout, still managing your risk because your other ancillaries are telling you you're not wrong yet. You're not wrong yet. You're not wrong yet. And so why those are your best trades is because the other guys got shook out. The other longs are the ones that get shook out, that run it down a little bit. Now there's less sellers in the book because the weak longs are out and you were able to weather the storm. You
Right.
know? And that's how you identify it. Your best trades are the ones you're able to weather a little bit of the storm, and spreads have helped you do that. Have helped you do that. As long as what got you in the trade is still looking right.
Right. So if I was an outright trader and I was trading treasuries, I might have taken heat and puked this trade. And then my setup would have been to, this is a big indicator for me. Double bottoms, double tops. I love seeing markets go to, old price points. And then the second, anything turns, like you can see in the DAX turning lower in the bobble turning bid, or the boom turning bid here, right here. As soon as that happens, I would be back in long an outright position. You have support from this prior price point. You now have, like Anthony said, you got a lot of people that just puked their longs from the prior period. I mean, this is an hour later. I mean, you got a lot of time involved here of people, being stuck long and taking a lot of heat. At this point, any turn in the market of a bid, I mean, this is a pretty significant bid here for me. It's breaking out of all these highs and turning bid. I mean, I'm getting long at whatever price I can get.
No, that's trading. I mean, that explanation is trading. Period. The thought process of even if you got out, you're looking to you still like the direction, you just don't like the heat when you were just trading outrights. And the spreads allowed you to stretch out your time. And I like the way you put it, smooth out the volatility of the trade.
Yeah, I don't make as much on an out as I would on an outright move, but I'm able to weather a lot of heat that I can't handle anymore. I mean, I'm wrong a lot, you know.
Yeah,
You got
that's
to be
what.
perfect trading outrights.
Yeah, you got it right. You can't hold on to losers because you think, well, I'm weathering the storm. You still have to have an exit, and you can't. You got to know what risk is and what too much risk is. What I'm getting better at is even taking um, a more what I call a helicopter view and just try to trade it from one side. So I still want to get in and out, but not bullish, bearish, bullish, bearish, bullish, bearish. Yeah, I did okay, but maybe I should have just stayed bullish. And I was right to go bullish to bearish because short term it was doing that. But just stay on the side of path of least resistance based on what you're seeing from a helicopter.
What do you
And
do when it's choppy?
I try not while I'm trading while I'm not trading. Like I caught the move off the lows
I mean, what
up
do you do in that?
nothing. The,
That's
yeah, absolutely. This is the S. What is this?
the S&Ps. That's yesterday's market.
Yeah, yesterday was terrible. Yesterday
What
had a
do you
four
do
point
then?
first hour range. Nothing. I think I
Yeah.
had two trades. And if you have a higher frequency amount of trades, you're down money unless you were absolutely perfect. Like I
Because
tell everyone,
there's no trend there.
there's nothing. There's no good bias, and there's no follow through. There's no way to say, you could be right for so many ticks and then it comes right back. It's not going to get away too far away from any one price. And you end up trying to do what was working 3 days ago on that day. Didn't work. Now today, for a good 30 minutes after yelling, first 15 minutes were good. I was able to catch a long through where it started, and the treasuries helped get me in the same direction because they're moving the same direction because of Fed policy being discussed. And then that was it. It got choppy and tough, and then you had to kind of keep your hand off the mouse, or you were going to get chopped up for the next 45 minutes of her talking. But one thing I wanted to add is what you and I talked about 2 weeks ago when we scheduled this. Um, and maybe you could take us back to that date on the chart. Remember, it was Wednesday. Well, I should have the date in front of me. When it was a Wednesday late afternoon about Greece that they were going to ask Greece for different collateral. Was that it? Do you remember that story? They were going to ask Greece, the
Yeah,
ECB,
I'm
was
looking
it?
at my calendar for. Do you know what date we talked? Because it was the prior week.
It was a prior day, I thought.
Okay, well, when's the last time we? When was it? 2 weeks ago. What? When was
Let me
that?
look. Let me look. I'm reading some of your text messages here. All right. February 5th was the day before that. It was that Wednesday late afternoon is when they announced it, and stocks got buried. But then walk me through that explanation because that was, yeah, I
Well,
think it
that's
was,
unemployment. So we talked the 5th
I think we talked the 5th, and this story broke on late afternoon U.S. time.
on Friday.
No, it was a Wednesday. Wednesday would be,
Jeez.
yeah, Wednesday the 4th. That might be it. Is it, what is that date? 2/4/15? It was
Yeah,
right there. See that sell off from, no, I don't know if that was, well, that's the 5 year.
yeah.
Okay, all right.
Well, I remember it was caused at. This isn't it.
But the whole conversation went that that event should have gotten bonds strong and stocks weak, and it did immediately after it. Stocks sold off, bonds rallied when that comment and that story broke late afternoon U.S. time. Then you woke up and you're looking at the European market, and you seen what?
Um, the stock. I think it was on a Monday. Well, whatever. The stocks opened up, or the DAX opened up, and the stocks opened up stronger. The Boon and the Bob opened up at 1 o'clock or 1 a.m. lower than where the Treasury, the U.S. market was trading at. So when that happened, I'm trying to get to the exact example here.
Well, you had said something interesting. Every central bank, it seemed like they were looking to buy every asset they could. And so when the European markets opened and rallied them and opened up strong, that gave you a bullish bias to U.S. stocks when we were to open up because you couldn't break on negative news. And it was clear how they came in and bought anything they could buy when Europe opened up.
Right.
And then the bonds went and financials or interest rate products went down. So try to follow that, guys, with what I'm saying. Bonds and should have went up, and they did. Stocks should have went down, and they did. But there was no follow-through from a negative story like that. And that was clear when he seen the buying come in on the open, because Woj trades the open of the European session, which is 1 a.m. Chicago time. And I'm going to build on this example because I'd like to a few times a week, like you had told me, text you, and you could kind of give me an idea what you're seeing overnight, if there's any kind of bias in stocks that you would have. But I want to build on this because, did you find it or no?
No, I can't find it. This isn't it. This doesn't look like the same thing
Yeah,
we're talking about.
no. But so you had said they had come in and they didn't sell off European equities, they bought them
Right.
and they sold stock.
They sold treasuries.
So now you come in and with a bullish bias into the S&Ps that day. And the S&Ps did have a big move up, but not right away. And I had said to you, Say, I said, Woj, I had a bullish bias. I said, but the bonds sometimes will give me a good helper and get me in. And you stopped me and said, but you didn't want to buy the S&Ps because the bonds were kind of strong, weren't they? I says, exactly. He says, well, you got to watch the 2 year, the short end. Remember that?
Yeah.
Because the short end, you said, if it's in the middle of its range, ignore it. No help. But if you got the bonds at the high end of the range and you look at the 2 year note and it's at their lows, that's the key. That should give you more confidence to ignore the bonds in that situation and start to execute or be confident with your bullish bias in stocks, because the long end will probably go down and that'll give you the fuel for stocks to go up and fill out your bullish bias, right? So that
Yeah.
conversation lit me up to the short end. So now the short end today,
It's very
okay,
strong.
right, when it got strong, it got me long it felt good to get long the S&Ps. Today they move together, at least near term when it's central bank policy, and I want to get into why, but they do. So that got strong, and it actually dragged the bonds off the bottom. If you were trading the bonds and used the 2 year, you had a couple good buys about 10, 15 minutes after Yellen started talking. The 2 year led it, because when the 2 year goes, bid, whereas the next two offers go bid, that's a huge move in the 2 year, right, Woj? I mean, they don't move
Yeah.
like that. They're so thick. When they move up or down 2 or 3 ticks, that's a big move, right?
Yeah, let me show you. I actually did exactly what you're talking about. Uh, I made a pretty good trade off of the 2 year. Before Yellen started talking, I noticed the 2 year was very strong. Now, like I said, the roll is a big play right now, so maybe there's a play in the roll. They're buying the March over the June 2 year, and that just maybe took precedence the whole day. But this move up, I got to correlate these. Oh, shit. No.
Is it locking up? Hey,
Yeah,
I forget it. You were the guy that turned me on to dark screens background, and then you went to gray screens. I stayed with the dark. Do you remember you went to black background on your charts? It was
Yeah,
easier on your eyes, and then you said gray is even a little better.
yeah.
Yeah. Well, you're the first guy that I seen black background charts that I liked. Because when you use white, you don't realize it, but it's a glare.
I I picked a low this morning after Yellen was talking.
Well, while you're doing that, I'll say that CQG is like the Rolls-Royce of charting software. It was on the floor at the Board of Trade in the Merc. You pull up charts, they'd have different stations around the floor. BCQG stands for charts, quotes, and graphs. They're not cheap at all. If you think that charting software that's 100, 200 bucks a month is expensive, what does CQG charge, Woj?
It depends on how many exchanges you have. I'm paying about $1,100 a month.
Yeah. So that is, I mean, they're the Rolls Royce, and they're really good for if you need to pull up different spreads and things like that. And they're easy to work on and work with. As the first charts that I had, not just from the floor, I didn't really know how to manipulate charts, but remember at DE, that's what we had. Two or three guys would share software, and we stretch it over a few monitors, but simple software to get around. All right, go ahead.
This isn't showing. I'm not seeing the bid out of the 2 year. This isn't giving us good example. But what I saw out of the 2 year, off its low here, it turned
This is
bid.
after. This is after.
This is after the sell-off after Janet Yellen. So this is 9:04. This is 4 minutes after she released her text and started talking. The 2 year bid came back with a vengeance. It was so big that I bought the 5 year somewhere in the middle of on the right screen or on the right chart is the 5 year. And I bought 5 year and I sold 2 year, and that was a really good spread because the way you weight the The 5-year is going to outperform the 2-year, and as you, as you can see, just by tick value, ticks are on the right of the 5-year, and you can see just how many more ticks the 5-year went up. But that led us off the bottom. It doesn't. This doesn't give it the credence that we're looking for as far as showing you a good example, because they both look like they move up together. But the 2-year turned bid so strong, while the 5-year was, it might have been 100 bid by 500, then the 500 would get taken out, and it's 100 by 400, where the 2-year was bid 10,000 by 5,000. So the bid was coming in on the bid side where it still looked like there were sellers in the 5-year. That's a real important game for me that I've learned over the last couple of years, where I think paper is at in the books. It's hard to see and recognize now. But when you see the let's go back to the 5-year again. 5-year was 100 by 300 on the offer. The 2-year was 10,000 by 4,000. So there's a bid in the 2-year, and there was still an offer in the 10-year, or the 5-year is what it looked like. And just by looking at how strong they were buying the 2-year, I had a really good bet that was going to be the bottom.
You're using order flow to see the 2-year come in bid first and probably lead the rest of the curve up.
Right. Had I not seen the 2-year, I would have never have put that spread on.
And that's the fight, right? The 5s over the 2s? You bought the 5, sold the 2s?
Tough. 2-year over 5-year.
Oh, 2 over 5. So you actually sold the 2s. You actually sold that spread, which gets you along the 5s. Is there an outright, or is there a spread? You just do that? You lift the offer in that spread, 2s over 5?
Yeah, on the CM or on the Board of Trade, they have an implied market, which is a guaranteed exchange spread. It's called an ICS spread, and then you can find it. It's called the tough.
Is that how you'll execute it, or will you leg in it?
I'll leg into it.
Oh, you will in the outrights. You won't do it on the just lift an offer in the spread.
No, it's too. There's so much less risk of getting hung in the tough versus a fight or a knob. So the fight is a 5-year over 10-year. The knob is notes over bonds, 10-year notes over bonds. Okay. With those spreads, you're at a very good chance of getting hung somewhere, and we're only looking to make a little bit out of the spread, so we'll put big size on. And if I have a lot of size on, and if I miss my leg, either whatever way I'm trying to get into it, if I miss one part of that spread, I'm in a lot of trouble. So I'll go to the ICS for a guaranteed market that's an exchange-traded product on the Board of Trade and use that. So if anybody wants to pull up the Fight Guaranteed, it's literally called Fight ICS. You can see it's thick, and there's a lot to do. If you buy or sell it, you're guaranteed. You're not, there's no execution risk.
Well, if you're hung though on you got an outright on, do you just cover that in and of itself?
No, I'll put the spread on. If I miss the spread by a tick or two, I'll leg up, I'll hedge myself, and then just put more on to even out my prices.
I got it. So you legged into this, which means you bought the 5s and tried to sell the 2s. Did you just go in and lift the 5-year offer, or did you just?
Yeah, I did. As soon as I saw the big size coming in on the 2-year.
You lifted the 5 first and then worked?
Yeah, I was able to work the 2-year because there was so much size on the bid.
Now, will you sometimes get greedy and say, I could steal an extra tick or two, I can offer it here, even though I could get it and get the spread locked in where I want? I see that offer go bid and work
once or twice, but for me, if I want to do that, I might as well just trade outrights.
I was going to say, yeah.
You're better off just trading the outright and covering your winner.
So you're going to say, I want this spread at this price, I can get the offer, I'm not going to squeeze it. I'm going to you lift the offer in the 5-year and work the offer in the 2s, you got it where you want it.
Right.
The best case scenario is working the bid, getting the bid in the 5s, working the offer in the 2s, and getting the offer in the 2s, but that's going to be hard. You got to work both sides.
That's called getting both edges, and that's really hard to do.
Yeah. So you just lift the offer, work the offer. Now, I don't expect everyone in the room to follow that kind of cadence, but you got to. You got to get into, and quoting will help you, work an offer, know a bid. You notice when Woj was talking about the size, he was going 10,000 by 5,000, always the bid quantity first and then the offer quantity. 10,000 on the bid, 5,000 on the offer, is could be, if you think of it like, I don't want to say top heavy because that usually goes down, but just it's imbalanced, right, with more buyers, and so it's going to leak higher just based on size. And that's not always true because the size could come in and out and fluctuate. But just that initial reaction, if they're real buyers, it's going up in the 2 year. And if the 2 year is going to drag up the rest of the 5, 10s, and 30s, like it did, that spike that you have on your chart is what I recognize. And I said in the room today that you could bought the bonds off of that. If you're just trading outright bonds, you could have lifted the bonds and probably caught the turn pretty quickly and then rode it up, be proven correct sooner rather than later. So anyways, going back to that conversation, it just built into me watching more of the short end than I was. And it's helped me quantify the importance of the bond and the stock bond relationship even a little bit better. So what I think will help everybody in this in this in this webinar today that Woj is doing is how important relationships are. They're everything. In staying in a trade that's good, getting out of a trade that's not good, knowing that it's just not price that you should be so sensitive with, because that's my weakness. Why wouldn't I be sensitive to price? I am. I'm trying to back out of that and be able, because I got good directional calls. I just want to stay in it longer without spreading off the risk. And to do that is taking more of a helicopter approach and not trying to get long and short in the same 20 minutes, but sacrificing some bearish trades, just waiting for the bullish trades to line up. And if I'm right on direction, I'll do good because I'll pick good locations. I'll pick good locations to get in. It's all about not turning from a bull to a bear. Has spread trading allowed you not to flip back and forth like that?
Yeah, it's almost impossible to do that. I still get chopped up getting out of the spread and then putting it back on. So if I think, for going back to this example over here where I was able to weather the storm, had the market traded below here and I puked these, and all of a sudden if we started to trend higher again and I put the spread back on, I can miss my legs putting the spread back on. I can miss legs getting out. That's where I get into trouble, and all spreaders do it. Meaning, if I need to puke this, I'm most likely giving up both sides of the spread. So I'm selling on the bid and I'm buying on the offer, and that's just, that's such an expensive part of the spread. It doesn't sound like that to you guys. And when I first started spreading, it didn't make any sense to me, but now after doing it for about 5 years, it makes a lot of sense, and that just kills your day, especially if you get back into the spread. Let's say, for an example, if I had the bias of getting long and I bought it again and I get chopped up getting long, that's about as miserable as, what Anthony's talking about, buying highs and selling lows, flip-flopping every 20 minutes. That's where we get into trouble as spreaders.
Okay. So it's impossible to get both.
Trying to get long, getting short,
It's impossible to get both edges of the spread, like you said. But then you give it up. It's like I can't get it, but why am I giving it up? Type of scenario. Right. You can't sell the offer, buy the bid to get in, but you're gonna lift an offer and hit a bid to get out. It's like, well, that ain't gonna work. Do that enough. Your trading hours are what? Typically, you went through them with yesterday. Go over them again.
I'll start trading. I'll start looking at the new day at 2 p.m. Chicago time. It's when settles come out for the CME. So what that means is the settles come out. That gives you a new net change for Asia, Europe, and the next day in U.S. markets. So I'll start trading at 2 p.m. and then we close at 4. We reopen at 5. I'll start watching again at 5, and then typically it starts to slow down and through Asia. And I'll go into the office around midnight and work till about 5 a.m., 6 a.m. Unless there's
You'll,
a unless there's big stuff coming out like today. I went in a little later. I went in about 4 a.m.
but you'll watch these stuff at 2 p.m. Central from home,
Right.
and then go to sleep at whatever time, wake up at midnight, get to the office for the European Open, right?
Yeah, not everybody trades like I do. I'm a little cracked.
All right. But so, do most guys come in for the European Open though, or no?
See about half the office.
Okay. And then are you gone before U.S. Opens, or like an hour or two into it?
Yeah, I want to be out of there by 6 a.m. So that's an hour and a half before the bond pit opens and two
All right.
hours before.
Let me ask you this: at 2, 4, are you looking? What are you looking at 4 o'clock p.m.?
I'm hoping to see a trend, and then at 2 o'clock I want to see people take that position off. So if we're running into 2 p.m.'s close today, I want to see a pullback after 2 o'clock. I want to see people that were long and they're taking their money off the table, and I want to see a pullback, and I want to go back with the trend.
So 2 o'clock, just so you guys know, Central Time is when the cash bond market's close, and that's like the 3 o'clock close in stocks. It's 2 for treasuries, and so you're saying after 2 that they start selling after 2, so there's
Yeah,
a
they're going to take
pullback.
their profits, right?
Okay.
Makes sense.
What
I
if they
want to
do
see
it?
them do that aggressively, and I want a big pullback. I love trends. I mean, trends make it easy for me to figure out what I want to do.
Especially with the spreads, especially
Yeah,
in spreads, yeah,
I mean,
directionally. Let
yeah.
me ask you this: when they sell off, what if they sell off before 2 into
I
the
gotta
close?
wait. I
Okay,
have to wait. It might screw my settles up, which means so on a mean reversion basis in spreads. Let's just take a look at the 5-year here. If we're able to, let's get rid of these. 'Cause if this were 130 and the market were, how do you do the line? I can draw. I guess
on the panel,
here. I got it.
you got it.
So let's say the market sells off at 130, and we're trading around down here. Or that would be a monster pullback, and I wouldn't care what spread prices are. I'm going to get long some kind of a spread that is bullish bias. Let's say the market's here. That would be a more accurate. At 150, at 130, if that happens, and we're chopping around, and at 2 o'clock, my settles are going to be 0. The net change on the day is going to be 0. Well, at 2 o'clock, if we close here and then sell off, the net change is going to be down 3 ticks. That helps me out a lot. That gives every spreader or every even consider you as an outright trader. If the market's down 5 handles and it's up 20 on the day, and now it's only up 15, but it looks like it's down 5 handles at on the reopen, it feels a lot better to buy something cheap
Got it. I
on
like
the
that.
day
Yeah.
versus it's not up 15 handles anymore. It's down 5. When we close 15 handles higher or 20 handles higher, just use that as an example in the S&Ps. How do you conceptually think? Okay, I'm buying an S&P because it's a bull market. It's the right thing to do, but it's up 20 handles. Well, after 2 o'clock or after 3 o'clock when we settle, it's really if we pull back from 2 o'clock to here, it's now down 5 handles. Well, doesn't that make a lot? Doesn't it feel a lot easier to buy it down 5 handles versus up 20?
Yeah, and here's a big reason why: because some profit taking had already taken place, so you shook out some longs, and that's the selling that pushed it down. You want to shake out longs for it to re-rally because
I
there's
want
less
to I want
sellers.
to buy a springboard, or I want I want a good shot at being wrong and still being right. So if the market sells off after 2 o'clock and my spreads, let's just keep using the example of down 5 handles, well, if it goes down another handle, okay, it's only down one handle. Well, really, it's down six. From the high print
Yes.
to here, it's down six handles. Well, really, it's only down one now. I can
Yes.
weather that tick against me or that handle against me.
The rubber band is stretched further.
Right.
Yeah. It's stretched further when you buy pullbacks on
Sorry
trends.
for
That's why you got to know. That's all right. That's why you got to know where you're at on that rubber band analogy, where you're at as in context. That gives you great context as to other people being long better than you. So if you buy it near the high of the move at this point, there's a lot. Everybody who's long is better than you. If you were to buy it up 20 handles, and it's still up 20 handles, you're buying it with a lot of people long. Now it might still keep going up, but when profit takers come in that are now sellers, that's what's going to create the pullback or the retracement. Pullback, retracement mean the same thing. Remember the saying, after you buy it, you're a seller. After you sell it, you're a buyer. To open positions, you now are the other side. So you got to know where you're at, because you get long in the face of people taking profits from their longs, you're in trouble, because that you're not giving yourself that bounce. Now, all right, so that what's a good takeaway for me and for everyone in the room to look at when we start our day? What would be your advice to say that you guys need to look at? You understand how important relationships are even before you started talking, because they've been through and with me. This just further cements how important intermarket correlations are. What would you say is important to prepare to have a better bias, not necessarily intraday, but before the session?
Well, you got to look at what happened overnight, right? I mean, you guys are coming into a fresh day that's already been trading for 7 hours. Um, then, then take then take a look at what you think should have happened, what the market expectations were, and if they didn't happen. So if you're supposed to be bullish, like Anthony and I were talking about, we're trying to find an example of what was supposed to happen and it didn't. Those are the biggest takeaways for me. When when the treasuries are supposed to be bullish and rallying and they're not, I'm looking for any kind of indication to get short. A SPOO uptick, any kind of a rally out of the DAX or a sell-off in the bobble or the boom. I like things that are going the opposite way of where they're supposed to be. That's, I mean, it's just normal. Then after that, it's just normal homework. Support, resistance. You guys don't have much resistance anymore, but
No, not in stocks. It's just it's good when it's something that shakes it up and you're going to get a two-sided trade. But when it reverts, you just got to be patient now and know that the bulls takes a lot for them to stay wrong and create that two-sidedness. You know who taught me that? Probably taught you that too, was Dave. The best clue is when something doesn't happen that should have happened.
right, exactly. I still use that.
Did he teach you that too?
Yeah, 15 years later.
Yeah, we're still using the same thing. The best clue is what should have happened but didn't. Um, it should go up. Here's the way he used the example. I remember specifically, he would be like, the S&Ps were going down, so the boon should go up, and it usually would, but it didn't. It stopped going up, and he could actually tell people in the office were banging on their desks because they were long and they weren't getting paid. They might have been long with a chance to scratch it or take a one-tick loser, but they weren't getting 1, 2, 3 tick profits, and they should have. And he knew right away that as soon as the S&Ps went up, sell the boon, because not only do you have some stuck longs, but it's not doing what it should do, and that starts to get people stuck in the way it should go, and that's what creates that as a self-fulfilling prophecy. There's just someone bigger that's absorbing all the longs or all the buying, and that created the. I mean, that's when I picked up on the best clue is when it doesn't do what the hell it's supposed to do, based on a relationship or a relationship with a news event. Um, anything from Yellen? Like, did you? It's just as if she didn't talk, she didn't create any smoke signals that you take from or seen after her testimony, was there?
Not really. I didn't see much. I think that she's given them looser guidance when they remove the word patients. That can mean that they don't have to go in 2 months. The rule was if she removed patients, they were going to probably cut in the next 2 months, and she's kind of saying it doesn't have to be in 2 months. But then she also said it could be any time. So I don't know why the bond market is reacting so bullishly on this, and I'm sure in a week we'll be, right back to where we started, maybe even by the end of the week.
You do,
Um,
do you have a directional bias if you were to start trading right now? No.
yeah, I'm going to go with the trend, and hopefully, like I was saying, at 2 o'clock we get a pullback between 2 and 2:30, and I'm able to get long some of this stuff.
Um, are you at 1 o'clock in the morning? What are you looking to do? Same thing, just build off of what you just went through. So when you get to the office for the Europe Open,
It depends on how we close. So because Europe closes at what, 2 o'clock our time, 2 p.m.
10:30. Oh no, 12. Or did they move that? The interest rates used to close at noon our time. European interest rates.
2:30. Oh no, 3 o'clock. So they close at 3 o'clock. So I want to see a nice, strong move between 3 and 4 o'clock in the afternoon, and then I want to see no follow through at 1 a.m. in the Boone and the Bobble. So if we rally from 3 o'clock to 4 o'clock and then continue that rally through Asia, I want to see the Boone and the Bobble open up at or below they closed at the day before. Does that make sense?
Yeah. Now it's just location now. You have a bias. You're looking for location.
Right. I hope we keep drifting higher all night, and then 1 o'clock tomorrow morning, I want to see the Boone and the Bobble open right where they're at, right where they close, and that's a pretty good indicator to the rally's over for the U.S. market.
If the
You can
boon,
use that example too in Euro Stocks DAX to the S&Ps.
yeah, I'm gonna work on that to have a better briefing and better bias going into that helicopter approach
I mean, it's
because
probably good for a couple of maybe a handle or two.
well, what do you mean right on the open?
Yeah.
Well, I just even think I know they don't catch up to it's not that big a information to say, well, Eurostox broke overnight, so the S&Ps are going to break a ton. They've already broke with them, but um, the upside is not the right side anymore. That indication, or it is, and let's not fight this thing and let's scalp the first part of the position from the long side and try to hold something for the move. Look where the shorts are stuck, so to speak. These footprint charts and ability to read the front ends that are now called domes are you can spot where the shorts are stuck and where the longs are really stuck. It just really helps to be on the right side of a macro direction, even if it's an intraday, longer term direction. You know what I mean?
Right.
Then just look for buy stops because these shorts, just wait for these shorts to get stuck. That's your location to get long and not take a lot of heat and just play that. Because right now, what are you going to do in the S&Ps? Buy the highs every time it goes up there. It's a death march. You got to catch
Be
you got to catch
rich.
a shakeout. Right. Long term, you would be as us as day traders. You get chipped chipped away on. Let me one other question, and then a couple guys got questions, Woj, and then we'll let you roll, man. Is what was I going to say? Oh, in the past, I told some guys you interviewed guys at DE, the firm we started at. When you hire new traders, you would be the first interview or one of the first interviews, right? And
Yeah, I helped out.
and then you did the you went your own prop firm, and then some stuff you're doing at your the prop firm you're with now. What's one thing when you interview guys, not qualify them that they have a chance, but say this guy no chance, he's done. I'm not even gonna. Uh,
If he's not coachable, if you're getting an argumentative, if you get that tension in the interview or just that vibe from the person, you can sense that everything you say, he's going to have some kind of combative, argument or. Um,
you're wrong, he's right type of conversation.
right. There's just going to always be another conversation on top of yours or his point of view over yours. The biggest thing for me was because I'm hiring a guy that really needs a job and probably doesn't know what he's doing, he should be very eager to learn and very coachable. And you can just kind of sense that somebody with aggressive personality might not be the best
Like
candidate.
a know-it-all. That's powerful.
Right.
That what you just said, being coachable, because we're still coachable. You and
Right.
I still want to hear something with someone saying that's working. You know,
Exactly.
I'm not here to say, like, I know that you traded for 15 years like me in your career. So when you're saying things, I'm not thinking to myself, nah, that's bullshit. That ain't gonna work. Why would,
Right.
yeah, okay, yeah, what is it, 2 years gonna, yeah, all right. If I was, I'd never be a trader. If you're not, like, open to realistic ideas that are rational. I think that that's cool that you said that, because guys who are not coachable are not here. They're not in this webinar today. It's a big filter with the education I have. That's almost by default filters guys that aren't coachable, because you got to learn something. If you don't want to learn and you think you know it, then go buy a system, or or why are you even talking to me in the first place if you know it all? If you know it, or if you think I'm wrong, no problem. That's a good filter that I'm going to use with people to cut conversation short. If I mean, they people do want to know why this could help them or why that could help them, and that's fair. But if they're trying to tell you more about what they know, what you're saying, if that's an interview, this is a guy that's going to get weeded out, because he's just going to make a class 3 times longer by debating. This isn't about debating.
Right. It's a debate with some guys. Exactly. That's exactly what happens. And I don't have time for that. I mean, um, there's only a limited amount of time in a day for me to work, and then to help someone else. I mean,
Yeah.
if they have
And
all the answers already, like you said, what are they doing in
what are they
my
doing
office?
in your shop? They should
Right.
have their own shop. You
Right.
know. When I couldn't make a damn dollar standing in the Dow pit. I didn't lose a lot, but I could not make a dollar. And that's why I went to a prop firm. I didn't go to a prop firm and say, now wait a second, I want more money. Because you want more money? Go back to the pit, try to make more money. I went there because I needed a different environment to be able to trade different markets, or else it wasn't going to work. So I went there with a complete open mind to what was going to be taught to me. I knew we had skill when we sat down there, but we still listened to what the hell was going on. Remember those equity meetings that we would have with Paul Bottom, and I mean, now he was a good trader, but he was there ahead of us, so he knew things that we didn't know to look at, to look for. And then they would have other meetings about the learning more about how numbers affect the market and events affect the market that I didn't know, even as a clerk and a pit trader. I had a sense of what was supposed to happen with numbers, but not with the events and stuff. That Scott, remember Scott and Scott, how sharp they were?
Yeah.
They were
I do.
smart guys. They were half trader, half
Analysts.
analyst. Yeah, that was unique. Most analysts can't trade, and most traders, usually have a good sense of numbers, but they're not analyst type. But these guys were. You ever see any or hear about any one of
I
those
was
two
just going
guys?
to tell you, a risk manager that used to run our shop, I ran into him a few days ago, Dante, and he said that Scott Coburn is over there, and they just promoted him to COO of
Oh, good. He's at
Diversified.
Dante's shop.
Yeah,
Nice, nice. I didn't know that they were together. Did he hire him originally?
yeah. Huh?
Did he hire Scott originally?
Yeah, a long time ago.
And the other Scott lives in Tennessee, but he was
Right.
trading down there. He's one of the smartest guys I ever met. Not necessarily trading wise, but everything wise. He's a smart guy. You're number two. All
Right.
right. Let me ask a couple questions or send them to you. Will you come back in like a month? Do
Yeah.
this again? Talk about some things
If
that
you
happened
guys
in
do
this
this
month.
weekly or bi-weekly, let me know. And if there's anything juicy for me to point out, I can just chime in real quick and show you.
No, that's a good idea. All right.
And if there's nothing going on, I'll see you guys in a month.
A couple of these questions are kind of been answered through the dialogue. Let me just go through here. Ken, who's a footsie trader, and Ken, uh, Woj's
Nice.
first market was the footsie, right?
Yeah.
First electronic market was the footsie. He asks, does Woj use any interest rate product as an ancillary for the DAX, Euro stocks, or the footsie? What would you say if you're a footsie trader? What would you watch?
The pound sterling.
But how about interest rate wise? The
Oh,
boom
that is
bobble?
interesting. Yeah.
I'm sorry. I'm thinking the pound currency.
Use short sterling. That's a good. And then, so what you got to consider is the Bank of England and the Federal Reserve were kind of on the cusp of hiking rates versus the rest of the world that was easing. So we didn't have the same kind of ancillary markets that, say, if you're trading oats, which is in France, versus the tenure and the boon, at least everybody was easing over there. And we didn't have that luxury of, oh, the DAX is up, so buy bonds. Well, the DAX might be up and the boom might be down, and the U.S. tenure might be up. It's been the craziest last 6 months that I've seen for trying to pick out nice similar markets to trade off of. Now that the rest of the world is kind of still, I think the rest of the world is actually dragging the inflation market down for the U.S. Although the jobs market looks nice and rosy, I don't think it's as good as everybody thinks it is. Having said that, I think that we are starting to couple back with the rest of the interest rate and equity markets. So as a footsie trader, looking at something from the Bank of England standpoint, I think you're able to trade off of Euro stocks and DAX a lot easier than you probably have seen in the last 6 months. Ask him if he's noticed it's been more difficult because they've been in a rate hike environment. And now they're kind of easing off that hike environment rhetoric.
So over the last 6 months, as opposed to now, or it's coming more in line. They're more correlated.
Yeah, I think you can trade off for more products where he was probably looking at it and saying, every time the ECB would talk and be bearish or bullish for DAX, and he's probably trading a footsie and it's not moving.
Yeah. No, they're and that's the thing is they you instead of getting frustrated why you got fundamental reasons why the central banks, and it usually doesn't happen where the central banks, especially the big ones, are at odds like that. Fed, ECB, and Bank of England have always been on the same, hawkish or dovish cycle. They're in the same cycles, and this is kind of different from my career, probably our careers, where they're almost you got QE and ECB and talking about a rate liftoff in the Fed, in our Fed. They're at odds, and they're not always in the exact same cycle, but similar. And I think
Right.
that's what's backed off the BOE and the Fed from raising rates. They would have done it already if it hadn't been for
The big
Eurozone.
QE program out of Europe.
Yeah. Type it in, Josh. Here. He goes, yes, the last few months those correlations have been awful. And there's your reason.
Yeah, you're just kind of you're on your own out there. I mean, you're really on your literally on your own island. And
But
if you
the
see a
short
lot of,
sterling is the direct. What expiration is that?
it's probably coming up on June.
Yeah, but is it a 2 year or they have all expirations? I never traded that.
Look for the 5 year. The 5 year.
5, okay.
Let me see if I'll find it and I'll text it to you later. But I used to trade short sterling to Euribor a little bit ago.
Your Euribor is like euro dollars, right?
Yeah.
Very short term. All right. Is Woj spreading 10s against 30-year, which is the knob, 10-year over 30-year? They seem to move in the same direction. Are you trading the knob, 10 over 30?
I was, but getting back to what I said earlier, the 30-year is now becoming, so the way you look at it is what is the duration of each product? The 10-year is a 7-year. It expires in 7 years. The bond right now expires in 15 years. And next month, so we're rolling this week. So when we roll from March to June, the 30-year actually has a 21-year duration. So from a 7-year to a 15-year, now a 7-year to a 21-year. I have to see and wait what these new ratios are going to look like. Right now, I trade the knob 2-by-1, 2 10-year to every 1 bond. Now they're going to talk about it as being a 3 10-year to 1 bond, and I need to see what these ranges and volatility looks like. One thing that you'll see over and over again if you're interested in spreading is how we come up with these ratios, and it's all standard deviations of DV01. It gets a little complicated when you talk about that, but they're just how much money am I risking per basis point move in the 5-year versus the 10-year. I want to have an equal amount of, I want to make $30 in one product and I want to lose $30 in the other one. And that's how you kind of figure out what your ratios are going to be. And because this knob is changing almost to be like a fob, which is a 5-year to 30-year in ratio sense, I need to wait and see what's going to happen. Right now, I don't think there's a person in the world that knows what the knob is going to look like.
You want to make sure it's an accurate ratio.
Right. I might not even take the DV01 ratios, which is going to be a 3-by-1. That might not be the correct ratio, and I'll just change it by like a 10-day average volatility.
All right. Josh,
I do like the knob. It was a good trade.
Josh has got a good question. Going back to your earlier European session 10-year example, which was 5:30 in the morning, roughly our time, right? That double bottom that you stayed into. So you were able to stay in it using the DAX, Boone, and Bobble.
Right.
Could he give those European ancillaries the same amount of weight during the U.S. morning session? So after the U.S. was open. No.
I don't look at so I don't trade during the morning sessions, but I used to. When I used to, I didn't care what the DAX, Boone, or Bobble was doing. Unless there was a 7:30 ECB meeting, which happens once a month at 7:30 Chicago time, I didn't care what. I mean, there's no way that the U.S. markets are making a move without the Boone and Bobble following us. And if they weren't following us, I wouldn't care. So it only matters for me during European hours.
Second question he has. What size do you look for in the 2-year to identify paper coming in? Would it? And I know there's no hard and fast answer for this.
There isn't, unfortunately. I like to see offers or bids getting hit or lifted. If there's an offer and it gets lifted for no other reason, for example, going back to this morning when I was trying to show you a chart of like how I bought the 5-year over the 2-year, 5-year really wasn't trading bid. I mean, my example was there was 100 and there was probably 400 or 500 on the offer, where in the 2-year went from 10 to 15,000 bid and took out offers. I
So
mean,
there was
that's
not, they weren't just bidding, they were buying.
yeah, there was it's a screaming telltale indicator of like, okay, focus on a 2-year and a 3 cash. If most of you don't have cash markets because you don't trade the treasuries, but watch the shortest end of the curve that you can and see if there's a real bid here in the 2-year. And if they hit the 5-year, if they hit into the 5-year bid, they didn't touch the 2-year. Um, it's different every time for what size you're looking at because it just changes all the time. But usually during the morning sessions, it's a couple thousand bid and offered. And if they take out an offer, that's you really need to pay attention to that. It's a big deal. 2-year doesn't lead, and when it does, it's a stellar indicator.
Yeah, right. And it doesn't lead because it's not moving that much. You
Well,
have to
it's not
play.
a volatile product. We know where we're going to be at in 2 years, or we think we know. But where are we going to be at in 30 years? Well, what do you think is going to move fast or first, or more violently? The 30-year. We have no idea where rates are going to be. For
Yeah.
every fart in the market, I mean, that's going to move 5 times in price than the 2-year.
The thing is with the short end when it leads, it's a great one because it's not moving that much. To give you that information, only in a volatile type of environment with an event or something like that. But then also, um, like in the example you're talking about, the bonds are strong. The notes in the 5-year in the middle of the curve, don't really look at them. But if the 2-year is weak and the bonds are strong, you're more apt to say the bonds will get weak.
I'm going to sell a 5-year on any downtick in the bond.
Okay. So the 2-year overall is just in their range. It's not price action. So what I've helped people with, and quoting is a part of it, is order flow and seeing what actually trades, not just what's bid or offered. What's bid or offer is also important, especially if it's real. But if you lift, the best tell, and I had it recorded, is when someone came in and you could remember the noise that this would create. Someone came in the spoos, and this doesn't happen often, so when it does, it's a telltale. He came in and he offered real quickly. They hit, let's say, 9.5, and there were 500 at 9.5, and he got took out. And it was like, someone yelling with a knife, and someone just shoots him in the head. And they took him out and bid it, and that was it. It was going up. No two ways about it.
Well, he was puking. He's probably juicing the market a little bit, and that 500 lot got the ball rolling.
Yeah, and he just took him out, boom, and then the lid got taken out. Um, but that's that moment of qualification of how to still have really good order flow indication. But you got to know how to read the dome, not up and down the dome or ladder. You'll go crazy. Just at moments you want to trade or moments you might want to execute. Know what to look for. Know what to anticipate. Woj didn't know how to quote the market. He would have never been able to know a guy was bidding 10,000 and lifted 5,000 and bid 10,000 behind it, and yet the fives were still offered and downticked, and they couldn't downtick any of the 2-year. And it's like, all right, I've got my bottom picked, so to speak. And then you take a shot and you let the market tell you if you're right or wrong. You know what to do when you're wrong. When you know what to do when you're wrong is, and you could comment on this, Woj, when you know what to do when you're wrong, it's easier to get in. It's when
Right.
you're scared to death, it's because you don't know what to do when you're wrong. And that's the problem. You don't like to just put a stop in and say, okay, I know what to do when I'm wrong. I got a 4-tick stop. That's a very helpless feeling if you're just purely mechanical with your exits. You could have an idea where you want to get out, and you could put in a stop, but you don't want that to be just the end all of where you're out. You got to let real-time information be analyzed because you're trading. You're not holding. Let me ask or do one more question, Woj, if you don't mind.
No, that's cool.
Oh, here we go. 2 weeks ago, Here, let me ask this one real quick. Bob asked, when trading these, do you ever leg out on one side and work the other side?
So legging out to me is, let's say I'm long and short. I'm long the 5 year and I'm short the 10 year. So if I'm legging out, I might the way I work out of the spread most of the time is I cover one side and then I go to the market on the other. So if I'm short and I need to work, I need to get out of that short 10 year. I'll work the bid and then I'll just go to the market on the 5 year. Unless my ratios, and what I mean by ratios is the bid and offer. If my ratios on the bid and offer are conducive to working both edges, let me see what I'm going to use the S&P since most of you look at that.
So you're saying the offer and bid are
So,
thin.
yeah, so I have a bigger bid, so I'm more likely, if that was a 200 or 100 lot on the offer and a 500 lot on the bid, I'll work the offer versus going to the market, but I'll put a turn. I don't know what kind of technology you guys are using, but I'll put something on that bid where I don't want to miss that bid. If I have to sell that bid, I'll do whatever I have to.
Got it. Yeah,
Yeah,
that's
look
good.
at the ratio of that right now. Right now they're almost 1 to 1. But if that ratio of the bid and offer on size, is 500 to 1, why would you pay into that? Why would you sell into the bid?
And that's what quoting will allow you to understand. If you can't quote the market, you're not going to understand that the bid is a lot bigger or smaller than its offer. Like right now, if I'm going to sell it, I'm going to work the 11 quarters. It's only $1.90 and they're trading. I'm not going to hit the
Right.
11 evens. That'd be stupid.
That's a
And I,
3,000. That's a 400% edge right there.
yeah.
400% over the offer
So I
size.
would, and I would have got filled. It just went bid offer. So I wouldn't have hit the bid, but you got to know that. Now, if that changes, and it starts to level off and there's 300 up, now you got to watch. You got to lean on that bid. But right now, if you want to sell it, don't hit the 11s. Offer the 11 quarters. They're trading. But you got to
Right.
know that by quoting it. And what I told what's important is to quote just the handle. Right now, it's one even one quarter, right? Quarters are trading. There's 100 there. But there's a whole thing I rolled out to help people quote, like the words to use and bid first, offer second, bid then bid price then quantity, offer quantity then price, all that stuff. So once you get that, that's really the hard part. You just got to practice. And I tell them that you're not going to make $1 million knowing to quote, but those who do make millions of dollars, they know how to quote. Their mind's doing it. So it's a necessary step. I think a rung in the ladder. That's really important. All right, last stuff here. 2 weeks or so ago, I think I pointed out there was 1,000 lot. I think it was even bigger than that in the bonds. I don't think you would have been trading during this time because it was after the U.S. Open, Woj. But there was a big order. I think it was even like 1,500 bonds were bid at 28. I remember the price, and it went down there once, bounced, went down there a second time, bounced. The third time it went down. What would you do on the third time it went down there? It was right on
Nothing.
the low.
Nothing. Right. Oh, it's right on the low.
Yeah, if you were an outright trader. It was 28 bid for like 300, no, 1,500. And it was real, but they were chiseling away at them.
It just depends on what your technology is. See, I got pretty good stuff where I can buy it in front of that guy, and if the bid dwindles down to a certain percentage of what my skew is, I can flip out of it. I can sell those. But most of the time, they flip it so fast that you can't get out. Now you're in a two-tick
Right.
loser.
Well, and that's the thing, is you could lean on it once or twice.
Second time, I want to buy it in front of that guy all day long. I'll put bigger size the first time he touches it and it goes bid. I mean, I'm a pretty aggressive buyer on that. I think that's real paper. I think
But
that's
then as the more it tests it, the less it's going to hold.
right. There's a reason why it keeps going back to that price. Um, Markets like to take out big size.
Yeah. And you can lean on it for a while, but then you got to go the other way.
Right.
And remember Danny
Shrek.
Shrek? He said the thing that stuck with me is paper always went to the size in the pit. It was like a magnet. It
Markets always go to the paper, right?
always went to the paper, always went to the orders. So you could lean on it, but then don't lean on it. It's going to fall.
Right.
You know, there's another webinar I'll do to kind of walk people through why it's a magnet. The reason why it's a magnet is there's got to be sellers. If it's a bid, it's a magnet because there's sellers that are driving down to it. But that's a time for another event.
Yeah.
Jim, let's talk about that another time because that's a whole another thing on top of the execution and the dome you use. You guys got your own um, proprietary domes that were built, right, to trade
Yeah.
through. Yeah. But anyhow, Woj, I appreciate. I got these guys. This is recorded, so people could watch it and watch it again. The big takeaway is understanding relationships and building your your scenario based on other markets, not just
Yeah,
one.
try and rationalize what's happened overnight and or in the morning session, in the evening session, whatever session you guys trade. Try and rationalize what happened before that, and then there was a lot of fundamental news with Greece and Ukraine, and obviously Fed speak, and I think that's dying down, and the market's going to get back to brass tacks and just start trading and not freaking out on every headline. That'll help me out a lot. Um,
You like less volatility in spreads?
no, I like it. This hasn't been good volatility for 2 years ago when this Greece stuff was rearing its head. It was so good. I mean, every headline was a 5 tick move, and then a 5 tick follow through. Now it's 3 ticks, 4 ticks up, and 5 ticks down. It's really choppy in treasuries. I love volatility, but this has not been good volatility.
I see. But as a spread trader, you still like volatility as we do as outright guys.
Oh, for sure.
The one thing that spreads the big difference is you're kind of supposed to add the losers. You still got to be careful, but you're supposed to.
Oh
And
yeah,
obviously,
if
in
it gets
outright
away
you
from
can't.
you and it kept adding to it, I mean, you're 4 or 5 times how many add-ons you have. You know,
You could get away with adding the losers in spreads than with outrights, correct?
I would. I'm not sure. I mean, I look at outrights a lot different than the way I used to trade outrights was if I bought tens and it went offered at 9, I'm puking it. Now I'm saying, okay, tens are a great spot. I'll buy instead of buying 10 there, I'll buy 2,
Got it. Your
3, and
average,
then
yeah,
4 or 5. The next price all the way down to 6, and then I dump the whole load at 5. You know what I mean?
yeah.
I still puke fast, but I'll average my buys in a little better, and I'll pyramid them. So, like I said, if I got 10 to buy, I'll buy 2, then 3, then then
But
maybe
it's a predefined idea, and you're trading the area, not the price point.
right. I don't have to be so freaking perfect.
Yeah. Well, and that's makes trading tougher, and shakes you out of good trades. You know that your idea has to be good. Your execution has to be good to get in. Your execution has to be good to get out. And when anybody ever says, well, what's most important? Everything's important when you're risking money. Everything. Your technology, your everything. I mean, just it's all important. Anything that is stripped from it could, hinder your performance and not allow you to turn the corner. Just sessions like these. You said at your first session, hard work is just essential. It's important. And just sitting through a meeting like this, paying attention, is hard work. I mean, that's part of having good work ethic. It's about paying attention to things that matter. But staring at your screen all day, do you agree, isn't necessarily hard work?
No, like you said, this session might not have hit anybody, where it mattered to anybody, but uh, maybe in 3 sessions from now, somebody that didn't get anything from the next 2 sessions really picks up on something that we haven't talked about before. So, it's like reading a textbook, over trading. The first 10 chapters suck and you don't learn anything, and then the 11th chapter, teaches you something and you never forget it.
and he brings all the other 10 together and said, get it. No, that's good. All right, so Woj, thanks again for coming, man. I
All right.
appreciate it.
Good luck, guys.
All right, everyone's saying thank you in the chat to you as well. So we'll touch base throughout the next few weeks, but next month we'll put something on the calendar. But thanks again,
Okay,
man.
sounds good.
All right,
Okay, bye.
take care. I'll take the screen back. Don't shut anything down, Woj. Just
Okay.
you could exit out, or you'll shut everything down. I'm going to stop the recording.